What if I told you that £1,000 could be the start of a small financial revolution in your life? Imagine turning that £1,000 into £10,000 over time, not by luck or lottery, but by smart investing. It might sound like a stretch, but historically the stock market has returned around 7 to 10% per year, meaning your money could double roughly every 7 to 10 years. In fact, legendary investor Warren Buffett famously suggests that most people would do best by simply buying and holding a low-cost index fund. So how exactly should you invest £1,000 today, especially in the current 2025 market? I'm going to show you expert-backed strategies to put that £1,000 to work right now. Before we dive in, a quick but important disclaimer. I may be an accountant who lives and breathes numbers, but I'm not your financial advisor. The tips and strategies I share are general education information, not personal financial advice. Firstly, you need to know the basics before you invest. So you want to pay off high interest debt. I know, you clicked on this to hear about investing, not debt, but trust the accountant here. If you have high interest debt, like credit cards charging 20% plus, the best investment you can make is paying that off first. Why? Because eliminating a 25% interest payment is like getting a guaranteed 25% return, and you won't find a risk-free 25% return anywhere in the marketplace. The same goes for any critical needs. If you don't have an emergency fund, say a few months worth of expenses, consider setting aside some cash for that safety net. Second, you need to set clear goals and know your risk appetite. Take a moment to define your goal for this £1,000. Are you investing to build long-term wealth like retirement or financial independence? Or is this money for something like a house deposit or another major purchase in a few years? Because your goal will influence the best investment approach. So what's the 2025 market landscape and why now? You're probably wondering, is now even a good time to invest? And it is a fair question. The market has been a roller coaster the last few years. But here's a quick snapshot of where things stand. In terms of the stock market, despite some turbulence, US stocks recently hit all-time highs. The S&P 500 index reached a record 6,205 points in July. A big driver has been some optimism that interest rate hikes are finally ending. Investors are actually anticipating rate cuts ahead, which has boosted confidence in stocks and other risky investments. In Q2 2025, markets rallied strongly. The Nasdaq index is on fire with tech stocks, although the first half of 2025 overall was only moderately up. The key takeaway though, markets are forward looking, but short term anything can happen. We could see new highs or a pullback. It's time in the market that counts. In terms of interest rates in the economy, here in the UK, the economic situation is mixed. After aggressive rate hikes to fight inflation in recent years, the Bank of England's base rate is around 4.25% in mid-2025. There are signs that the UK economy has cooled. In fact, GDP has dipped for a couple of months now. And many experts think that the Bank of England will start cutting rates soon. One economics director even said an August interest rate cut looks pretty much inevitable. For investors, falling interest rates often boost stocks and bonds, since borrowing becomes cheaper for companies and savers start seeking higher returns in the market. But it's a double-edged sword. If rates drop, the great savings account rates we've enjoyed might go down as well. And if the economy is slowing too much, that could weigh on companies' earnings. The silver lining is that inflation has been coming under control. And with wage growth still decent, some predict consumer spending may pick up in late 2025. In terms of savings accounts, and speaking of interest rates, one positive of the recent high rate environment is that cash savings finally yield something decent. It's still not get rich money, but it's far better than near zero interest a few years back. As of now, many easy access savings accounts in the UK offer 4+% interest, with some competitive accounts even near 5%. Your first option is the safe path, which is the low risk move for £1,000. So let's start with the most cautious approach. For those who say, I really don't want to lose this money, I want it to grow a bit if possible though. If your risk tolerance is very low or your timeline is very short, I would consider these. Firstly, a high yield savings account or a cash ISA can yield around 4 to 5% right now, with virtually zero risk to your principal. It won't make you rich, but it will earn a bit of interest rate while keeping your money readily accessible. Similarly, short-term government bonds or premium bonds in the UK, premium bonds in particular are actually a no-risk lottery-like savings product. You can also overpay your loan or mortgage. This is not an investment in the traditional sense, but it does bear repeating. If you have a mortgage or any loan with moderate interest rate, using some of the £1,000 to pay it down is a guaranteed return equal to that of the interest rate. For For example, if your mortgage is, say, 5% interest, paying it down effectively earns 5%. You can also keep some cash flow opportunities. If you're extremely risk adverse, you might simply hold a portion of £1,000 in cash or safe savings and not invest it at all. There's merit in not investing money you might need soon. Another perspective is some cautious investors keep cash on hand to invest later if markets dip. Your second option or path is the balanced path. This is diversified investing for growth. This is the route that I actually recommend for most people, especially beginners who want to see that £1,000 grow significantly over time without any crazy risk. The balanced path is all about diversification and a long-term perspective. So you can use index funds and ETFs. In my opinion, the single best way to invest £1,000 for a beginner or even an experienced investor is to put it into a diversified low-cost index fund or ETF. Why? With one investment, you get a slice of hundreds of thousands of companies worldwide, dramatically reducing your risk of any one company taking over your portfolio. For example, you could buy a FTSE All-World ETF, which just covers global stocks, or a FTSE 100 index fund, which is the top 100 UK companies, or the famous S&P 500 ETF, which is the 500 largest US companies. These broad funds tend to mirror the market's long-term growth. Historically, the S&P 500 has returned around 10% a year, but closer to 7% after inflation. But at 7 to 10%, money doubles every 7 to 10 years, as we said. That's powerful for building wealth. And as a bonus, index funds are very low fees, often just 0.1 to 0.2% a year. And many platforms let you invest in them without any commission. You can also go for a mix of stocks and bonds. If you prefer a bit less volatility, you can split your investment between a stock index fund and a bond fund, or use a ready-made balanced fund. Bonds are loans to governments or companies, and they're generally steadier, though with lower returns than stocks. In 2025, you can find decent bond funds yielding maybe 3 to 5%. A classic balanced portfolio might be 60% stocks, 40% bonds, but you can adjust 80-20, 70-30, depending on your risk tolerance. You can also use a robo-advisor or managed portfolio. If you like the sound of diversification but aren't sure how to execute it, a robo-advisor could be your friend. Robo-advisory platforms will ask you about your goals and risk tolerance and invest your £1,000 in a spread of funds, usually a mix of global stocks and bonds that suits you. You can also go for dividend stocks or funds with a kind of income focus, another balanced approach angle. If you prefer investments that pay you regular income, you could consider dividend-focused funds or investment trusts. Some funds specifically hold companies that pay reliable dividends, like many FTSE 100 companies. With £1,000, the dividends might not be huge, maybe £30 to £50 a year if you're yielding 3 to 5%, say, but it is something. You can reinvest those dividends to buy more shares, and this accelerates growth via compounding. Option 3 and the adventurous path is high-risk, high-reward plays. So this is now for the spicy stuff. Let's say you have high risk tolerance or you really want to try and supercharge that £1,000. Firstly, you could opt for stock picking with a small portfolio of stocks. Instead of an index fund that holds hundreds of companies, you might decide to pick a few individual stocks that you believe in. With £1,000, you could buy shares of, say, 5 different companies, say £200 each, to get some diversification. Thanks to modern brokers offering fractional shares, you're not limited only to cheap stocks. You could put £100 into big names like Google or Tesla, even if their full share price is hundreds of pounds. If one of those companies skyrockets, your returns will beat the market. However, and this is a big however, your risk is much higher. Any single stock can flop just due to bad earnings, scandals, competition, etc. You could also opt for sectors or thematic bets. Rather than stock picking, you could invest in a thematic ETF or sector fund that targets high growth areas. For example, if in 2025 you're excited about artificial intelligence, renewable energy, biotechnology, etc., there are funds that focus on those. These are less diversified than broad index funds, but more diversified than single stocks. You could also opt for cryptocurrency and beyond. So crypto, the wild west of investing. Bitcoin or Ethereum or that new coin that your friend's cousin swears is the next best fit. The truth is £1,000 in crypto could either double in a year or be cut in half or worse. It is that volatile. While crypto has made some people millionaires, it's also lost people a lot of money. If you are crypto curious and fully understand the risks, you could put a small part of your £1,000, like £100 or £200 of that, into a cryptocurrency that you've researched. Alternatives beyond crypto could include things like crowdfunding investments, peer-to-peer lending, or even buying some gold or silver. Lastly on this, you could invest in yourself or a side business. Sometimes the highest return on investment isn't from a stock or fund at all, it is you. With £1,000, you could buy an online course or certificates that boost your career skills, start a small side hustle, or build a simple website for a business idea. For instance, you could spend maybe a few £100s on tools and supplies to kickstart a freelancing gig or e-commerce shop. If done right, that could turn £1,000 into a new income stream for you. So let's talk tax. You need to be tax smart. So no investing discussion, especially from an accountant, is complete without talking about tax efficiency. The government, lovely people that they are, offer some tax wrappers that can save you a lot of money in the long run. The first one, as we probably already know aware of, the stocks and shares ISA. In the UK, every adult gets an ISA allowance, currently £20,000 per year, which can grow completely tax-free. That means any investments you hold in a stocks and shares ISA, whether they double or even 10 times, you'll get no capital gains tax, and any dividends or interest earned, no tax. You also have a pension. Of this, you have a workplace pension, but also remember you have a SIP, which is self-investing pension. If this £1,000 is money you truly don't need until retirement, a SIP, a self-invested personal pension, could be very attractive. Why? Because the moment you contribute to a SIP, you get a 20% boost from the government in the form of tax relief, if you're a basic rate taxpayer. But if you're a higher rate taxpayer, you can claim even more. If you contribute £1,000 and it becomes £1,250 in your pension right away, the extra £250 is essentially your income back. That's an instant 25% gain before any market growth. Your investments then grow tax-free in a SIP as well. Here's the big catch though. The money is locked up until age 57. The pension access age is currently 55, but rising to 57 by 2028. Also, don't forget your workplace pension. If your employer offers matching contributions, take advantage of that first. Next is your tax on investments if you do it under a general account. If for some reason you don't use an ISA or a pension and invest via a normal brokerage account called a general investment account or GIA, be aware of the tax rules. Next, let's talk fees. You need to keep your costs low. Fees and charges really matter. It is an unsexy but crucial piece of advice. You need to minimize the fees you pay on your £1,000 investment. Firstly, you have broker fees. Different platforms have different fee structures. Some charge £5 to £10 per trade. Others are commission free, some have monthly account fees, but others don't for basic accounts. So do the maths. If you paid a £10 fee to invest £1,000, that's 1% gone immediately. In fact, one example, if your platform charges £10 per trade and you made 10 trades buying various assets with your £1,000, you'd spend £100 in fees, meaning you'd need 11% return just to break even. Nowadays, we have many low-cost brokers, Freetrade, eToro, Trading212, etc., to name a few, that offer zero commission stock or ETF trades, but always check. You also have fund fees, or these are called expense ratios. If you invest in funds or ETFs, they have an annual fee or an expense ratio. An index fund might charge as low as 0.07% per year, while an actively managed fund could charge 0.5% or 1% plus. It sounds small, but fees compound too. A high fee can seriously eat into your returns over decades. Be aware of account charges. Some providers charge per year for an ISA or other admin fees. These aren't deal breakers if the platform is good, but if your £1,000 is just sitting and you're paying £10 yearly, that's 1% per year lost. So in short, keep fees low and you'll keep more of your returns. This is an area where a little bit of research is needed. You could use sites like Money Saving Expert, and this can pay off handsomely. Here's some common mistakes to avoid. First one is emotional investing. Don't panic or follow hype. Humans are emotional and money multiplies these emotions. Two big killers of wealth are fear and greed. When markets drop, fear kicks in and people panic sell at the worst time. Whereas when markets soar or a hot stock or crypto is all over the news, greed kicks in and people buy at the peak just out of fear of missing out. To succeed, you need to be level-headed. Second, lack of diversification. We have touched on this, but it's worth stressing. Don't put all of that £1,000 into one stock or one narrow asset. It might feel exciting to bet all of it on one single company you love, but that's more gambling than investing. Next is ignoring costs and taxes. Another mistake is ignoring the boring fine print. We've already discussed how fees can basically eat away at your returns. You need to keep them low. Also, don't forget about taxes. Next is trading too much or chasing hot trades. Many beginners feel like they should be doing something constantly, buying, selling, swapping investments based on the latest news. In reality, over trading is often detrimental. Not only do you rack up fees or taxes, but you can also end up constantly buying high and selling low as trends basically whipsaw. The next one is not investing at all or waiting too long. Finally, a mistake that's super common is analysis paralysis, doing nothing because you're unsure. If you've watched this so far, you're already ahead of many because you're educating yourself. The next step is to take action, even if it is small. Maybe that means opening an ISA account and putting in just £500 of the £1,000 to work, and setting up £50 a month or to invest into a fund. Starting is the hardest part, but once you do, you'll learn more from having skin in the game. If you found this guide helpful, give it a thumbs up, and please consider subscribing for more insights. Drop a comment about how you plan to invest your next £1,000. I'd love to hear your ideas or any questions you still have.